Hi there. So, if you've been thinking about buying a home or refinancing your current mortgage, one of the most important things that you can consider and understand is going to be how interest rates affect that. Interest rates are these little numbers that can have a huge impact on how much you're going to be paying each and every month over the life of the loan. So today we're going to talk very briefly about what you need to know about interest rates and maybe some tips about what you can do to affect them. First, let's dive right in and talk about the interest rate itself and how it affects your monthly mortgage payment. So, we're going to start with just an example. And for this example, we're going to be talking about a $300,000 loan, and that loan is going to be for a term of 30 years. Okay, fixed. So let's talk about taking that example, $300,000 and 30 years of the term, and let's apply a 3% interest rate for just your principal and interest. Okay, we're not factoring in everything else, just the PMI, okay? Principals and interest. So at a 3% rate on that loan for that term, you would be looking at a monthly payment for that would be right around $1,265 per month. If we take that up even just 1 percentage point to 4%, now we're looking at a monthly payment of roughly $1,432. Pop that up even one more interest rate number to 5%, and now you're looking at roughly $1,610. So, as you can see, over time, that 1% difference can significantly impact your budget. So now let's look at that over a longer period of time, just to bring it into perspective. So for that same loan, at 3% interest rate over the life of the loan, you will have paid $155,000 in just interest payments. If we take that up to 5%, now you are looking at almost double. You would have paid $289,000 in interest on that $300,000 loan at a 5% interest rate for 30 years. Yep, that makes a difference. So now let's look about maybe some factors that you don't have any control over, but factors that do make your interest rate go up and down. So the first one that we can look at are economic indicators. These are going to be things like inflation, employment rates, and even economic growth. So I hate to break it to you guys, but the stronger the economy, the higher the interest rate. It's just kind of how it usually factors out. Another one that will affect your interest rate is going to be the Federal Reserve policy. And so while the Fed really doesn't set mortgage rates, the decisions that they make affect your mortgage interest rates and they do influence them. And the last one I want to talk about is market demand. So market demand influences it like this. The higher the demand for a mortgage, the higher the mortgage rates and the interest rates will probably be. The lower the demand for mortgages, then your interest rates might drop. So those are just some of the key indicators and the key factors that you really have no control over, but that are definitely going to affect the available mortgage rates to you. So let's talk about our third and probably most important tip around interest rates and your mortgage specifically. And that is going to be your personal financial health. This plays a huge role in the interest rate that you can get. Lenders always have offered better rates to borrowers with higher credit scores, with healthier credit histories. And the type of loan that you choose is also going to affect that. For example, like a fixed rate versus an adjustable rate. All those kind of things are going to affect the interest rates that are available to you. So since your interest rate, your credit score, those kind of things can be affected by some of the choices that you make, let's talk about how you can secure the best rate possible for yourself. Here are just 4 easy tips for you, okay? The first one is to boost your credit score. Pay down your debt, check your credit report for errors, get those cleaned up, and then go apply for your loan. A great mortgage lender is going to be able to do a quick check on that for you and help you get those scores up prior to putting you into a mortgage. So definitely look at that. The second thing that you can do is to actually shop around. get quotes from multiple lenders and then find the most competitive rates. Now, as a little side point here, it's not always all about the rate. Sometimes it's actually about the program overall. So talk again with a great mortgage professional that's going to be able to guide you and educate you on that. So it's not always just straight interest rate. The third thing I want you to consider is actually the mortgage points. This is something that you can buy down up front if you're planning on staying in your home for quite some time, and that is going to help you have lower rates, and it's going to save you more money in the long run. So definitely consider buying down some of those mortgage interest points. All right, the fourth one that you can do is to lock your interest rate. Once you find a good rate, lock it. Make it happen, because that's going to protect you from market fluctuation. So let's say that the interest rates go back up again. If you lock that interest rate at a good, solid, healthy one, then you won't have to worry about the interest rates going back up as you're going through that loan process. So remember, interest rates have a huge impact on your financial future. So it pays to stay informed and prepared. Even small steps like improving your credit score and comparing lenders can make a big, big difference on your monthly budget. So if you have any questions, if you need some help navigating the mortgage process, I am not the girl that's going to be able to help you with that, but I have some excellent referrals for you. So please don't hesitate to reach out. We'd love to get you connected with them and make sure that you have a great guide through this process. Thanks so much for watching. We'll catch you on our next video.